Welcome back, everyone, to the HFRX June 2024 Performance Snapshot. Hi, Ken. Thanks for joining us.
Hello, Nigla.
So how did things look in June?
June was another strong performance for the HFRX, for the hedge fund industry, and for the HFRX, really rounding out a very strong first half of the year. In the month of June, we continued to see moderating inflationary pressures, although they were still persistent. There continued to be speculation on how much interest rates would be cut in the second half of the year. But most importantly, we continued to see the building of geopolitical risk and uncertainty around European elections, around the upcoming U.S. election, and around the ongoing military conflict throughout the globe.
I see. So looking at June specifically, what are the top performing strategies for the month?
Yeah, you can see here that the leading area was the HFRX Equity Hedge Index, which gained about 1.25%, slightly above U.S. equities here. And I just want to comment briefly. There was actually a pretty wide continuum of equity performance for the month. Some indices were up more, and some were, for example, the Nasdaq, S&P were up more. The Russell and other indices were actually down more. And so this is really kind of a midpoint of how equities did. Overall, you can see the equity hedge up 1.25%, up about 1/3% for fixed income based relative value. You did see interest rates fall over the course of the month. And then the overall HFRX index ended the first half with a gain of about 1/4% for the month. And then you can see that event driven and macro both declined in June, about 1/4% for event driven and 70 basis points for the macro CTA index.
Got it. So sub-strategy wise, how is June looking?
Yeah, we really saw a continuation of a lot of the trends from May, as well as really most of the first half of the year in June. So there weren't any huge changes or inflection points here. Fundamental growth has been a strong area of performance, as we'll see when we look at the year-to-date slides. 1.9% gain in June, which is very strong, well ahead of the equity markets for sure. And then equity market neutral, which is very interesting because, as you know, equity market neutral is generally a strategy that has very little net exposure and tries to produce gains based on portfolio composition and mean reverting qualities in every month, and not have directional net long or short exposure. So you see a gain of 1.4% there. Obviously, that ahead of 1.1% for overall U.S. equities. Still strong gains, fundamental value, convertible arbitrage, and then macro discretionary up about 0.5%. That for the month of June.
All right. So if we look at the year to date, what's the story there?
Yeah, we've really seen a continuation of a lot of the same trends, which are driven by leadership from equity hedge and macro. It's interesting, categorically, equity hedge does well in with directional exposure in risk on environments, and macro is typically the lowest correlated, does well in risk off and volatility increasing environments. So the fact that we've seen both of those two as the leading areas of performance is exciting, and really a testament to what an interesting environment we've seen in the first half of the year. We've really seen both sides of the coin in terms of market micro cycles over the course of the first half of the year. Both of those areas obviously ahead of U.S. equities. We have here 3.8%. But overall, the global, which is obviously an index of all the different strategies that you see here, 2.84%. 117 for fixed income based relative value. And then the lowest area of performance thus far in the first half of the year, gain about 90 basis points for event driven strategies.
I see. So sub-strategy wise, year to date, what is the strongest area?
Yeah, these have been actually pretty consistent. There hasn't been a lot of turnover in the leading areas of performance in the last couple of months. And for the first half of the year, you can see fundamental growth. The leading area at 7.8%, 6.9% for macro systematic diversified. Again, those, as you know, are trend following quantitative strategies that are typically trading liquid futures contracts long and short based on statistical models and forecasting that continue to go up, or the weakening trend that is going to reverse at some point in the future. We talked about market neutral, how it's generally factor based, very low net exposure, 4.25% there, and 3.8% gain in fundamental value, which, as you know, is categorically long and short, and net long, 80 net long, 30 net short, undervalued stocks and shorting overvalued stocks. You can see, and that's pretty much in line with what you have for U.S. equities. And then we also have there with a gain just about 2% convertible arbitrage, which has been strong the last couple months as well. So overall, it's been a good month of June and a good first half of the year for the hedge fund industry.
All right. And so that wraps up our performance snapshot for June. Thank you, Ken.
Yeah, just as I wanted to point out, we do have our new website that's up, and I encourage everybody to visit that. Some great new features there for investors and users of the indices. So you can visit the website, www.hfr.com. When you do go there, please click on the investor guidebook. It's a really great summary of how a lot of institutions are using the indices for benchmarking now, and highlights some of the utility of the investable indices. If you're watching this video, you know that we do regular videos on YouTube. And so please continue to look there. And also, if you'd like to subscribe to the channel, and if you have questions or there's other items that you'd like us to cover on future calls, you can go ahead and ask those directly. And then finally, of course, if you'd like to set up a call to discuss anything you see here, please, you can send an email to indices@hfr.com, or you can email me, Ken Hines, or anybody that you do work with at HFR, and they'll direct you to me to arrange a call. Thanks, Aniqua, and thanks for watching, and we look forward to speaking with you again next week.
Thanks, Ken.